Quick little update on the Pershing Square Foundation. We're now up to about 400 million in grants since that last fact, so we're something we take quite seriously. So I want to talk about a business that people think about as a pretty risky business, the land development business. Why is it risky? Well, it's enormously capital intensive. You need to make it a very large upfront investment. You can only get recourse leverage. It takes time to get zoning, you get approvals, you're all ready to go. The market changes, you have to go forward. Anyway. And your profits are in the last few lots that you sell. So this is a very high-risk business. What's interesting is the 27th wealthiest man in America, and by the way, I think Forbes' number's wrong. He's in here for $15.2 billion. This is Donald Bren. A lot of people have never heard of Donald Bren. He's a land developer. He basically did one deal, or one very, very large deal. He built a master plan community. He took over a master plan community called the Irvine Ranch. That's been his life for the last 40 years. My guess is his net worth is closer to 30 or more than $30 billion. And one way to find a great business is to look in the Forbes 400 and see where people made their money. And what's interesting here is he did this wasn't, he got the cycle right. He's been doing it for 40 years. That tells you he's been through the best and the worst in real estate. That picture on the left is the Irvine Ranch master plan community, which he purchased in 1976. 40-odd years later, it's one of the best places to live in the country. And he's done a remarkable job. Now, one of the keys to investing in master plan communities and land development is you don't want to be the first guy. He stepped in more than a decade after the planning took place. You want to be the second owner or perhaps the third owner. You want to get in after a large upfront investment has been made, the community is established. So what is a master plan community? It's typically what we describe it as a more than 10,000 acre property. It's a piece of raw land that has been designed almost like building a city with a lot of forethought, but instead of a traditional government, you've got one owner, and if you have an owner with a long-term approach, a lot of very long-term value can be created. And the key is making sure you have the right assets in the right places. You start out putting in infrastructure, then you start selling some lots, then you start building all the amenities necessary to make it an attractive place to live, and eventually you have a fairly remarkable business. So the Irvine Ranch is 93,000 acres. It's about a fifth of Orange County. And he bought it with a group of investors for about $337 million. A good chunk of that money was borrowed. Over time, he bought out all his partners. He owns 100% personally. And he was pressured over many years to sell pieces of the ranch, and he refused. He retained all of it, or effectively all of it. It's now got a population of 250,000 people. It's considered the safest big city to live in America. And it's been a remarkable investment. I couldn't figure out what his actual original capital investment here is, but he turned a relatively small amount of money as a minority investor in this deal. I think it was less than 30% into at least a $15 billion fortune. So what did he do? Well, first he started off with very good real estate. Location, location, location certainly applies. He bought into an existing master plan community where a big investment had already been made. He used the increasing value of the land to minimize the equity required so he could avoid having outside partners. In fact, he was able to buy out his partners over time. He used debt, a modest, appropriate amount of leverage, municipal financing. These are basically tax increment bonds where you build infrastructure and you issue municipal bonds to pay for it. And he kept his balance sheet conservatively financed. He controlled the supply of land, so he never dumped land on the market. He would only make sure that home builders bought enough, but not too much. And he was careful about not overbuilding. And again, he controlled the zoning, he can control the timing, the release of land, and he was the developer. And he took a very long-term view. This was going to be his legacy. And his guiding principles were, number one, maintain the land under a single owner, because only one person could have this kind of a vision, wouldn't have to argue about what to do. Think very long-term, the master plan, constantly update the planning, continue to reinvest in the land, be careful, land stewardship, long-term view, make every city in the Irvine Ranch an important and happy place to live, and just make sound decisions. These are basically their principles. So actually go back one more slide. Okay, next, here we go. So he says, the problem is, he says, developing this property is the best possible way is the most important thing in my life. I expect to be working well into my 90s, and he's approaching his 90s. He says, it's not for sale. And so here I am in a conference talking about public investments, and you can't invest. So the question is, how can you invest? Along with, or at least in the style of Don Bren. And the answer is a public company called the Howard Hughes Corporation. This is a public company that we formed about 6 years ago. And what's interesting about it is it's got 5 master plan communities around the country with very similar qualities to the Irvine Ranch. The Seaport District, and it's a district, it's the only privately owned district in Manhattan, and we're going to talk about that. Downtown Columbia we won't talk about, but it's actually it's ranked 4th in the country in terms of places to live. In Houston, we own the Woodlands and Bridgeland. I'm chairman of the board of the Howard Hughes Company. In Summerlin, we have the most valuable real estate, a 24,000-acre master plan community. And in Hawaii, we have an urban master plan community. We own 60 acres on the beach with 9 million square feet of approvals. And like the Irvine Ranch, we're coming in not as the first owner, but in many cases, the 3rd owner or later. Our oldest master plan community is in Columbia. We've got over 5 million square feet of vertical development to do there. All the lots have been sold. That's a 50-odd-year-old project. The Woodlands, we still got lots to sell. It's 30,000 acres. It's twice the size of Manhattan. Howard Hughes controls the zoning. I call this Sim City, but for real. Summerlin, 22,000 acres, of which we own the remaining 4,000 undeveloped acres. Bridgeland, a lot more to go because it's a younger community. The South Street Seaport, which is 400,000 square feet of street retail in New York, a 65,000 square foot rooftop. And Ward Village in Hawaii, which is 9 million square feet of development. So just a bit in terms of history, Howard Hughes, you think of him as an aviator, but he actually apparently made most of his money in real estate. Well, he's inherited a lot, but then he invested in real estate. He acquired Summerlin. And then Rouse bought Summerlin. And then General Growth bought Rouse. They bought Rouse for the shopping centers, didn't take much interest in these master plan communities. We got involved when GGP filed for bankruptcy, and that's when we bought out the 50% interest in Summerlin was held by the heirs of Howard Hughes. And then Howard Hughes began its existence when we formed the company and spun it out of General Growth. Just a little bit of history on the company. We bought 25% of GGP in 2008 for $60 million. It filed for bankruptcy in April of 2009. I talked about it at this conference in May of 2009. I think the stock at the time was around $1. We bought out the Hughes heirs. The company emerged from Chapter 11. Investors made a 100-fold return versus the November 2008 price. All the bondholders got their money back. We formed Howard Hughes. We spun it off to shareholders, and we got backing from Blackstone, Brookfield, Fairholme, and us. In 2011, we bought the 47.5% of the Woodlands that was held by the Morgan Stanley Real Estate Fund, again, to consolidate ownership. In 2012, we bought out Brookfield, Fairholme, and Blackstone. We then exited GGP, and we retained our stake in Howard Hughes. And we've never sold a share. We never talked publicly about the company. So the question is, why are we talking about it now? The answer is, I think this is one of the most attractive times in the history of the company to invest. The stock trades at one of the widest discrepancies between the underlying net asset value. And we have a much better understanding of the business, and the business has had a huge head start over the last 6 years. So if you look at the Irvine Ranch principles, we've adopted them. Sole owner in Howard Hughes, thoughtful master plan, continual reinvestment in the land, minimizing third-party equity, in fact, buying out our partners, long-term approach, judiciously selling land but not dumping land on the market, and being an appropriate long-term steward. We've got a conservative balance sheet. We stopped selling commercial land. When owned by others, GGP, they would sell off land basically to pay debt service. We stopped land sales. In fact, we started buying out parts of the MPCs we didn't control because we understood that once you get to a certain tipping point, the commercial development opportunity becomes large. Once you get beyond a certain population, you can start building vertically. And we control effectively all of the commercial and residential vacant land, and we control the zoning. And when you own these assets in the later stages of a master plan community, you can build enormous value. And it's a business with a virtuous cycle. So you start by selling lots to home builders. That brings in a population that creates demand for shopping centers, office buildings. You build the buildings, they generate cash flows, and so on and so forth. That makes it a more appealing place to live. You can sell residential lots at a higher price, and the cycle continues. Let me give you a few examples of the MPCs that are owned by Howard Hughes. The Woodlands, for anyone who's been to Texas, it's one of the considered the most desirable place to live in Houston. It's a city, as I mentioned, twice the size of Manhattan. We own the vacant land. We control the zoning. We control the timing of supply. 115,000 residents, ranked as the best place to live in Texas, the 6th best place to live in the country. ExxonMobil just moved their corporate campus very close to the Woodlands, a 5 million square foot campus. And in fact, we did a build-to-suit for Exxon in the property. Perfect example, we saw this nice piece of vacant land. We said, what should we do there? We came up with an idea. Fast forward, in 2.5 years, we built 1.5 million square feet of space, leased it up, and are generating ultimately $50 million of net operating income from this property. Unlike a REIT that has to buy land or buy buildings, we have an enormous amount of internal development opportunities. There's more than 50 million square feet of unbuilt vertical opportunity inside this company. This is Summerlin. You get a sense of the scale of this community. Again, about 1.5 times the size of Manhattan. This is Las Vegas. It's 9 miles from the Strip. It's 25 years old. The most attractive place to live in Las Vegas is an irreplaceable asset you could not create today. We did a deal with Discovery. People know Discovery Land. We're selling land in the desert, 77 lots for $250 million. You can do the math, $4 million lots in the desert. It gives you an idea of how valuable a master plan community is and the remaining land in that community. We kept the commercial land, so we didn't sell it to others. We built out the community around it. The best way to see that is by going to this picture. So all that surrounding property and development, those are the households, and we saved to the end the commercial property. You build the commercial property. Obviously, once you have that kind of density, it becomes enormously valuable. If you think about real estate, typically you build a building. If you do a great job, you help all your neighbors around you make their properties more valuable. Here we own all the property, and therefore we get the benefit for the company. This is what downtown Summerlin looked like in 2010, and this is what it looks like today. It's a spectacular. It's made, of course, the Summerlin a much more attractive place to live because it's got an attractive downtown. That, of course, enables us to sell lots at higher prices. That increases the density. That improves the retail sales, which means we can increase rents. It's a pretty interesting business. So the overall approach is continue to sell lots. We're building the population in these various communities, stabilize the existing assets. These are office buildings, retail, shopping centers, apartments that we built, and then build new ones. We've got 50 million square feet of development inside this company. The vast majority of this land is unlevered, no debt on it. 37 million are within the 4 walls of our master plan community. We're going to finish the South Street Seaport. I'm going to talk about that in a second. We're going to deliver more condo towers in Hawaii. The question is, what's this business worth? So the problem here is, if you were to take a look at the financial statements for the Irvine Ranch, it would be hard to make heads or tails of it. This is a development business. There's a huge amount of depreciation. There's a lot of capital going in. GAAP accounting, it's just not a good way to think about the business. Looking at short-term cash flows, they're incredibly volatile based on this quarter's land sales. That doesn't really tell you much. Book value is not a reflection of long-term asset value. And so we think the best approach is what I would call a back-of-the-envelope approach. Certainly one that I can do in 15 minutes in front of a group. So the easiest thing to value is we've got operating assets. These are recently constructed assets that are in various stages of lease-up. About $240 million of stabilized NOI. You can assign a cap rate. We believe they'll be at this level in 2 years. Discount back those cash flows. Now, what's interesting is because these assets are largely within master plan communities and we control the supply, this is much less risky real estate. So the risk of the problem with many real estate deals is in one market you need 1 more apartment building, and then you got 4 developers who build 1 more apartment building at the same time. Here we can control and prevent that problem from happening. So the cap rate that you would use to value these assets is meaningfully lower. If you think about the residential land, a lot of people think of land development as a risky business, but when you're selling the remaining lots in an established community, it's a certainty that those lots will be sold. The macro factors will have some impact in terms of the exact timing of the sale, but you're going to sell them. And generally, those assets appreciate at a rate similar to where we think you should discount those cash flows because of the high certainty. So you can actually look at today's values to assess a value for those assets. And then we have a bunch of other stuff. So an asset, 110 North Wacker, was the old headquarters for GGP. We're building a 1.35 million square foot office building. We just signed a lease with Bank of America to take 500,000 square feet, and it goes on. And I've got to accelerate because I'm running out of time. So we think the operating assets, that's the stabilized or the approaching stabilized income producing assets, the residential land, those lots that will be sold over time, and a list of other assets, including 110 North Wacker, is about equal to the enterprise value of the company and the per share value of the business at $120 a share. So what else do you get for your money? Well, you get this. This is the new South Street Seaport. If you go downtown, it actually looks like this today. It's not open yet. It's going to open in 2018. But this is 400,000 square feet, about 170,000 square feet in the pier. The next building over is what's called the Tin Building, a 50,000 square foot building, plus all that other land to the west is part of this asset. And this is going to be a spectacular place to work, to entertain, to have fun, to go to concerts. The roof deck holds 4,000 people for an outdoor concert. Jean-Georges is opening up the equivalent of Harrods Marketplace in this location. And this is one of the most valuable pieces of real estate I've seen in my career. It's going to open in a year. You get it for free. You also get this. This is 60 acres in Hawaii at the beach with an approval for over 9 million square feet of new buildings. And in fact, we've made a lot of progress. We've built almost 1,100 condominiums. Actually, we've sold 1,100. We're about 86% sold, and we're building a new development, again, only as needed. There's no pressure, but we only build until we see the demand. This is what it looks like last year. Here's one of the completed buildings, and it goes on. Next. That's what it looks like fully built out. And again, once you build a whole bunch of high-rise condominiums, of course, it makes the street retail more valuable. The most valuable, or one of the most valuable shopping centers in the country is located less than a half a mile from the project. It's called the Ala Moana Shopping Center. It's worth, recently was sold, half an interest was sold for a couple $2 billion, and we own a similarly sized retail opportunity in this location. What else do you get for your money? You get 37 million square feet of development in the MPCs that has yet to be built, and these are projects on which we expect to earn a high return. How can you get a sense of that? Well, we've built almost 4 million square feet over the last 6 years, NOI of about 144 million, about a 9% return on cost. These assets we think are 5-6% type assets. And the opportunity going forward is about 10x that. You get that for free. And then you say, what about taxes? What's interesting is this is a very tax-efficient business for the most part. Depreciation, interest expense. We've had the benefit of significant NOLs. We have some high basis assets. The nature of land development allows you to defer taxation. And we're, of course, a beneficiary of a reduction in tax rates. Our balance sheet is almost entirely non-recourse. We limit the amount of recourse debt that we have. We're about 2/3 non-recourse. We've got a great management team. And the CEO is compensated in a bit of an unusual way. When we spun the company to shareholders, he invested $15 million in 6-year warrants he couldn't sell until the 5th year. He still owns them. They expire in November. Obviously, his incentive is to see a higher share price. But he's going to reinvest $50 million in new warrants when he sells the old warrants and retain $50 million of